Okay, Chapter 12, Problem 1. Let's take a look at this. And as always, let's make sure we know what the hell we're talking about before we go any further. This company acquired $290 million of 6% bonds. The management has the positive intent and ability to hold, so these are carried at their amortized cost. The bonds will be held to maturity. The market rate, the yield was 7. So we got these at a discount. They paid $260. See, I told you so. The company will receive interest semi-annually, so we need to know that. And on December 31st, as a result of the changing market conditions, the fair value of the bonds was $270 million. Well, let's address that first. Who cares? Since we're going to hold these to maturity, we're told we carry these at their amortized cost, or their unamortized cost, rather. So this is nice to know, but it's irrelevant for this particular problem. So the first thing it wants us to do is do the journal entry for their investment. Well, their total investment was $290 million, so we got that. And they paid $260 million, so that's how much cash went out. And the difference between those is the discount. So that's that piece. Now we have to figure out how we're going to record the entry. Well, this company is going to pay $290 million times 6% divided by 2. That's what they're actually going to be paying. So let's see what that works out to. 290, 1, 2, 3, 4, 5, 6, times 0.06, the face rate of interest, times twice a year. So that gives us a total of $8,700,000 is the cash that they're going to receive. $8.7 million. Now, doing the effective interest rate, we have to take a look at how much they actually paid. So the carrying value is $260 million times 7%. And again, they pay twice a year, so 260, 1, 2, 3, 4, 5, 6, times 0.07, the market rate of interest, times twice a year, so half of that, 9,100,000. So that's their interest revenue. And the amount of discount that is amortized is $0.4 or $400,000. Now, the next thing it asks us is how are we going to carry this on our balance sheet. So we got the 260, plus we got the 0.4 that we amortized. Okay, so we're going to carry this on our balance sheet at $260.4 million. Now, the last thing they say is we wanted to sell the bonds. For whatever reason, we wanted to sell the bonds. And we sold the bonds, all of them, for $250 million. So that's how much cash we got. So we got $250 million. We got rid of our investment in bonds of $290 million. But we had a discount. Now we have to remember what our discount was. Our discount was $30 million, but we took that 0.4 million, So our discount really is only 29.6 mil. And the difference between those, 10.4 million, is the loss on selling the bonds. Not a real difficult problem. Did give you a chance to refresh some things on bonds and to work through some of the rules, and not the least of which was that because they're holding this and they have the ability to hold it, we carry it at the amortized cost. So the fact that the rate went up is irrelevant. We don't do anything until we sell it, and then we recognize all gain or loss.